Hello everyone. Good afternoon, good morning. So with the Finance for Development Lab, we're very happy to welcome you for this webinar on debt for development swaps. I'm Martin Kessler. I'm the executive director of the Finance for Development Lab, which is an independent think tank based in Paris. And we've been kind of working around sovereign debt issues, development finance for a long time. With always the idea that debt swaps were not a panacea to solve debt and development problems, but could be a useful tool to increase funding for specific sustainable development goals. And so we've done in the past 2 years, a number of work around the theme and trying to identify where the potential gains were. And so I think that event, which we've seen is garnering a lot of interest, is to kind of explain a bit its work and have a dialogue with policymakers, practitioners in the field of the transactions, and to kind of see how they can best use how to gain the efficiencies in the system from debt for development swaps. I think our point was always that that neither specifically good or bad thing, but that they can there's are major inefficiencies in the system, in the development finance system, and that swaps can improve on the efficiencies and have financial gains. And I think the two papers that we're going to present today kind of want to illustrate how to identify those gains and how to make sure that those transactions are actually beneficial for the countries where they're in. Initially, transactions were very high. The cost of this transaction was high, and the question was really how useful they are. So the two papers that we're going to present, that Johan Rai and Jules Davy are going to present, are really around the measurement and the maximization of the benefits from those transactions. And we're very happy that we have three practitioners that can explain how in practice those deals have succeeded or how to improve on them. So without further ado, very happy to give the floor to Johan Rai, who's going to present the first paper, and the senior economist and has been at the lab for some time, and I'll give him the floor and allow him to present afterwards the other panelists. So thanks a lot again for your interest. Glad that you here, and Johan, go ahead.
Thank you very much, Martin. Hi, everyone. Good afternoon. Thank you for joining us today. My name is Johan Rai. I'm a senior economist at the lab, as Martin said, and I will present some of the results of a recent research that we have done, and that hopefully will try to set the scene for this webinar. So we will be stepping back a bit from individual transactions, and we will be trying to looking at the broader picture of the debt for development swap market, as we call it. And we will try to respond to three sets of questions during this first phase of the webinar. Then Jules will also present a more targeted study on Côte d'Ivoire and on one aspect of the transaction. And then, as Martin said, we'll open the floor to our very distinguished panelists, and finally have a Q&A session. So if you have any questions, please hold it for the last session. We'll try to make room for as many as possible. So as I was saying, we'll try to respond to three different questions for this research. The first one is getting to the basics about what are debt for development swaps. Then we'll go into the details about what happened in 2024 and what didn't happen in 2025. And finally, we would see what this tells us about the potential of debt for development swaps, their limitations, and what can be expected for the years to come. So let's start with a very basic presentation of what are debt for development swap. It's not a perfect one, but I think it can help for the non-experts on the topic to understand what are those very complex instruments. So a debt for development swap starts with this position where you have a debtor country that has an existing debt, let's say 100 million debt, sorry, with an existing creditor. This debt was negotiated at some point at 5% interest in the past, so it's a good deal that the debtor had, but now has to repay back and refinance this debt. The normal situation would be for the debtor to go to the market, borrow the same amount, $100, but if, and that was the case recently, interest rates have risen in the same time, the same debt, the same principal debt doesn't yield exactly the same debt service. And the debtor is in a situation where refinancing the existing debt is very expensive. What a debt for development swap tries to do and allows to do is, because of a credit enhancement, this existing debt is subscribed at a lower interest rate, for instance, at a lower debt service. And the savings made on these operations are dedicated by the debtor country in a long-term fiscal commitment towards development, for instance, education. So it's a situation where we swap one debt against another, so normally for the same principle, but the savings generated by this operation goes to a development topic. So that's the basics of it, and it's to clarify that debt for development swaps are not a debt relief. This is a misunderstanding that can have been spread in the news a lot, not from practitioners. And this misunderstanding probably comes from the fact that some other debt swaps that we will not be talking about today, the bilateral debt swaps, most of them embedded in the past some level of debt relief. So that's not what we are doing today. We are focusing really about the debt for development swap that are structured refinancing operations or liability management operations. But because they are supported by a development partner that provides a credit enhancements, for instance, it can be a warranty, an insurance, a political risk insurance. Because of this support from an official creditor, the savings are generated, and these positive savings can be used and earmarked to development program. It can be climate, nature, education, water, and so on, a development one. So three elements are very important to keep in mind. This liability management operation aspect of debt swaps. The other one is that there is no magic money in debt for development swap. What I mean by that is that the savings that will be earmarked, reallocated to development programs, don't come from nowhere. They come from the budget of the debtor country, and this is very important and key when those deals are negotiated and assessed. And the third and final point that I wanted to make in introduction is that debt for development swap are necessarily multi-stakeholder transactions. They involve a wide range of partners, obviously the issuer and the creditors, the new creditors, also the credit enhancer that plays the most pivotal role probably in those deals. But also, and we have some in the room today, the SDG sponsor that will probably help structure the deal and manage the funds that will be reallocated at the end. And also a lot of range of service providers. So it's something that needs a high level of coordination. So this framing was important to set the scene. And I think Martin said that debt for development swap attract a lot of attention because of this double dividend that they offer, improving the debt profiles of an entity that wanted to refinance debt and probably didn't have access to market at very profitable rates. And finally, also offers the dividend for the development partner to mobilize SDG funding in a way that manages its own capital. So in a context where ODA is shrinking for development partners, debt for development swap can be a way of leveraging the scarce public resources in a very smart manner. So to assess whether those development swaps finally deliver on this very, very positive narrative, we looked back on 2024, and 2024 was very interesting for a major reason, because In the final of the year 2024, so last year exactly, the market has accelerated and even doubled. It doubled in terms of the money that was funded for development purpose. So the end money that would go straight to the AGG commitments, but it's also more than doubled in the amount of debt that was allowed to be refinanced through the deals. So this really important volume increase kind of set the scene for to question whether the debt for development swap would move from a very niche instrument to something scalable. That was the expectation in 2024. We also saw out of some qualitative improvement in 2024. New countries entered the market. So as you can see from the map, all the countries in orange are all the new deals that happened in 2024. And we saw 3 new countries venturing this complex transaction, including Côte d'Ivoire, the first low-income country that managed to pull out one transaction. We also saw countries that went back to the market after a first attempt, which is a good sign, meaning that if you go once and want to go back, it's probably that the benefits are material for the debtor country. And also one debtor country, Ecuador, that still represents a large share of the market, but managed to pull out very important transaction. So this reunited the idea that debt for development swap might finally move, as I said, from isolated pilot transactions to something more scalable. However, when we looked a bit more into the details of the different deals that happened in 2024, what we saw is that they actually are very economically different. It's different transactions with the same label. Most of the transactions that happened in 2024 can be assessed and understood as refinancing operation. So countries that go to the market without being in a very high liquidity stress. So that sounds as a very positive aspect, but the outcome, I mean, the other side of this analysis is that when you go to the market without having a liquidity stress, the debt that you have to buy back is in most cases trading at the same level as you have to pay back. So it's at par. When you do that, the savings generated can't come from the principal of the debt because there is no discount, but from the debt service only. So that's the main aspect that we've seen in those deals. It's, as I said, something positive, meaning that countries did not go to the debt for development swap solution when they were facing a high liquidity stress. It also means that it could be applied to more countries, and this is what we would have expected. However, when we look at what finally happened in 2025, the market did not pick up, and the rivers, as we call it, didn't fall into a larger one. So far in 2025, and we never know what's going to happen in the next couple of weeks, but 2025 has seen no new commercial debt for development swap transaction. And I think that this pause is kind of revealing. Part of the explanation is that the sets of credit enhancers, and I think I've said in the beginning that credit enhancers, the guarantors, are very instrumental in the operations. So the number of credit enhancers has increased in 2024. But the main one was, let's say, on a technical pause. It's the USDFC, as you might have seen, has not pulled out any more transaction in 2025. And when the biggest player in the market steps back, the overall market is on a break. So that's probably one of the explanations. But there are also deeper reasons that we try to assess in the article. Debt for development swap transactions are complex and time-consuming, as any as any refinancing operations. As I said, they involve a lot of players. But there's also the SDG aspect, the long-term fiscal commitments that will be done to development that needs to be discussed. So this requires legal, financial, and institutional coordinations that goes probably way beyond a normal liability management operation. And so probably one of our hypotheses is that the time needed to negotiate those deals probably was done in 2025. And that explains that you cannot just roll a lot of transactions one after the other. Each transaction needs a separate time, and hopefully we'll have a discussion about that another session. And so this leads to the broader question that whether debt for development swaps are what we call an asset class. Can they move from single transactions to a product that is somehow standardized, allowing for comparisons among the different deals? Strictly speaking, and that's the spoiler, but debt for development are not considered as an asset class. An asset class is something that requires standardized instruments, consistent pricing, so you allow for relative value comparison, sufficient liquidity, so there is a secondary market, as you could have one for bonds or equities, etc. And that's not what debt for development swaps are. They are, as I said, individual transactions. They generate some financial instruments, such as the guaranteed loans or the different notes that will be issued within the process. And those transactions differ widely. That doesn't mean that, being an asset class is not an objective in itself. As we have seen, there are some similarities within the market, and there are encouraging signs that the debt for development swap is structuring in a common way. I've mentioned the fact that issuers are coming back to the market. I've also mentioned the broader set of guarantors that now are part of the deal. And also we'll probably have a talk about that, but there are some more and more efforts done by the stakeholders to structure and standardize some of the practices in the market. And that's a very good thing, but I think that 2024 is still laboratory phase. And I will now move to what I believe is one of the important bottlenecks of the debt for development swap, is the question of the savings. If you remember well on my first very basic drawing, these operations generate an amount of savings that is at the cornerstone of the transaction. This is the FDG commitment, money that will go to education, to conservation, you name the development objectives that you set. And those, the savings, as we have seen in the article that we have published, are computed in very different manners across the different deals. There is no standardized methodology to calculate them. Some deals will calculate them based on nominal terms, the face value of the debt, of the old debt, of the existing debt against the new debt. Some countries would compare mostly the value, taking into account the time of the value of the money in the future, so the net present value of the different debts, the different instruments. And some would even compare what would have happened if the country would have gone to the market without any support. So that's three different kinds of methodology that yield very different results. And what we are saying is that not that the numbers that are the headline numbers are necessarily wrong, is that there's a level of opaqueness behind this methodology that would need to be solved, because it has a natural impact for the debtor country. It's money that comes out from the budget every year for sometimes 15 to 20 years. So we advocate for a very clarified way of computing this, not an harmonized one, but a transparent one. And we believe that this amount of clarity and comparability could allow countries to make a more enlightened decision. So that's an aspect, and I will end with just a few elements for what to expect from 2026 and so on. So we believe that market conditions will still be the main driver, obviously, of debt for development swap. Do they make sense for the countries to go back to the market alone or with a credit enhancer? That's probably the key driver. But there's also a few aspects, institutional aspects, that will need some more research. And at the FDL, we are trying to put the resources for that. Those aspects concerns the donors and guarantors. Do they have sufficient resources to allocate to debt for development swap? against other solutions. Should they do more a loan or a guarantee? And that's kind of this arbitrage assessment that we'll try to put some resources on. And one, when we have actually already started, and I'm going to pass the mic to my colleague Jules, that has done some assessments on the value of those guarantees, the value of a publicly based guarantee in the context of the Côte d'Ivoire deal. Thank you all for listening.
Thank you, Johan. Hi, everyone. Thanks for joining this webinar. What I suggest now is to dig into a specific deal, which is the Côte d'Ivoire deal, and which is actually the last one before the temporary closing of the market that Johan suggests. This presentation is going to be based on a paper that I co-authored with Isaac Diwan, and that I invite you all obviously to read. Next slide, please, Johan. So now you must all understand the mechanics of a swap, but to describe it in the specific context of Côte d'Ivoire, very simply, you have the government that is buying back commercial loans that were out there already from private investors. And they're buying back thanks to a new loan that they issued. And this loan is guaranteed partly at 60% by the World Bank. Now you understand that because one is guaranteed and is used to buy back all the loans, there's financial benefits for Côte d'Ivoire. And the idea is for Côte d'Ivoire to use those gains for education. That's why it's called a debt for education swap. And the idea is to build around 30 schools thanks to this deal. So what we do in the paper essentially is to ask four questions that we think are essential. The first one is we look at how financially valuable for the Republic of Côte d'Ivoire the deal is. The second question that we ask is what is the contribution, what is the benefits of the guarantee, the policy-based guarantee PBG in the slides, in creating value for this deal. We then expand our analysis by looking at what we call the macroeconomic contribution, macroeconomic gains. I'll go more in details about what we mean by that. And finally, we propose some, let's say, some path, some leads to discuss potential improvement in the design of PBG. Next slide, please. So the first question then is how financially valuable is the swap? And it's maybe the most straightforward analysis of the paper because it's very clear that the deal is financially profitable for the country. And the rationale behind it, I mentioned it, is that you retire short-term loans with 8% total cost in terms of interest, and you swap it for much longer loan with lower interest rate. So this is where the mechanics of the financial gains come from, and you see this is pretty well in this case documented by the World Bank, and we've written the calculation, but that Côte d'Ivoire benefits in NPV gain, so on the stock of debt by 60 million reduction, and also in liquidity gains, so on debt servicing with savings of around 330 million over the next 5 years. The second thing that we think is really important to stress is the institutional innovation around this deal. And I think something that is really important and that is very central is that the deal doesn't use a special purpose vehicles like previous deals. This has many benefits for the country because SPVs are complicated to structure. It's costly as well to structure. One very important benefit as well is that the Republic of Côte d'Ivoire retains what we can say is sovereignty during the entirety of the program. What I mean by this is that SPV, the funds are blocked. You have to use them for the operation. In the case of Côte d'Ivoire, the funds go directly into the budget of the country, which can use it as it please, which is really important. And the question that may arise for now is how is the Republic incentivized if it can use it, if it goes straight into its budget? And this is where we think it's a very interesting transaction. The incentivize comes from the fact that it's the World Bank that is the guarantor, and for the first time in this operation in a swap, and the incentives comes from the program of the World Bank, where funds are more or less dispersed depending on the performance on the construction of schools. But the choice always remains in the hand of the Republic, which is something that is important to note. Next slide, please. So the next question then comes from the guarantee, the policy-based guarantee, because obviously there's the swap, and the swap is and then stands to that guarantee from the World Bank. But one could imagine different scenario to achieve the swap, different consensual or not financing to conduct the swap. We imagine 4 alternative options, and we look at the gains and the cost of each option compared to the actual swap. So the first scenario that we estimate is we take the same guarantee, but we swap. We imagine a swap with other loans, and in this case, a bond and a much longer term bond. So with a higher maturity, which is the 2040 bonds. So instead of the loans maturing around 2030, you swap this bond. And our projections show that you have higher gains in NPV because the bond trades at higher discounts. But obviously, you trade off this for liquidity gains because the advantage of swapping short-term loans is that you smooth your debt servicing in the near future, and you have liquidity gains. The second scenario that we look at is a strictly commercial swap. So in a sense, a traditional liability management operation. So in this case, there's no concessional guarantor, no MDBs that backs the deal. It's a strictly commercial. You swap old commercial loans for new commercial loans. And obviously, you imagine, and we see that there's much lower gains in NPV and liquidity because the whole advantage of a swap is that you have a guarantor that reduces the risk premium and attracts private investors at lower cost. And then there's 2 other scenarios, and I think it's really one big contribution of the paper. We imagine that instead of a guarantee, it's a blended borrowing. So it's a loan from the World Bank, from the EBRD, blended with a loan from the markets. And we imagine 2 different scenarios. One, when we replicate the ratios of of the actual deal with a guarantee. So 60% comes from concessional. So 60% in this case is not a guarantee, but it's the BRD loan, and 40% comes from the market. And then if you see on the last scenario, the ratio is different. It's 50%, 15% from EBRD and 85% from the market. Why do we take this scenario? It's very important. It's because, in a sense, guarantees, a policy-based guarantee, are subsidized. And why we say they're subsidized? We say they're subsidized because they only eat up 25% of the country's allocation. So they incentivize countries to use it, as it only eats up 25% of their country allocation. So the counterfactual then becomes not a 60% concessional loan, but 25% of those 60%. That's why we compare with this scenario with 15% EBRD and 85% coming from the market. And this has very significant implications, because you see that in one scenario, the scenario where the loan is not, the blended loan is not subsidized. You see lower gains in NPV and in liquidity. But in a scenario where such a loan would be equally subsidized, you see slightly higher gains in NPV and in liquidity compared to the policy-based guarantee. So what we say in the paper, what we conclude in the paper, is that the policy-based guarantee has bigger financial contribution than a traditional blended loan if it is implicitly subsidized. Next slide, please. So here we talked about financial gains, strictly financial gains. Then we looked at the PBG. I think one important contribution of the paper as well is to look at the broader gain, in a sense, the spillover effect of such a deal, what we call the macroeconomic contribution. And to summarize, what we see is that beside the financial gains, the cost of financing, the overall cost of financing for the Republic resulting from this deal is improving. And how do we say that? How do we see this? We look at secondary market trading of bonds, and we see a tightening of yields and spreads resulting from the operation. So I think it's something important to keep in mind that such operations, they don't only have strict financial gains, they also have broader macroeconomic gain for the sovereign. And we suspect that these gains come from signaling effect, because what is a swap? What is a swap for Côte d'Ivoire? It's essentially Côte d'Ivoire using scarce resources from the World Bank to improve its debt sustainability and its debt position. So it's essentially signaling to creditors that Côte d'Ivoire is willing to make costly efforts to improve its debt position, and which is a phenomenon that is strong, and we see concrete effect in the overall cost of financing for Côte d'Ivoire. Next slide, please. And the next slide is, and I will conclude here. It's maybe less so relevant in the context of Côte d'Ivoire. It's more like a broader discussion that we have in the paper around policy-based guarantee in light of our analysis. We're exploring pathways maybe to improve the design, or at least discuss it. So will be really interesting to have your feedback. We question or ask ourselves if we need to reconsider the use of this implicit subsidy that I've talked about on country allocation. Why? Because in a sense, it reduces signaling value, because you make it less costly for the sovereign to improve its debt profile. Also because obviously the World Bank has got a limited amount of resources. And if you subsidize one kind of instrument, it should have an impact on other kinds of instruments. We discussed as well maybe the leverage of PBG. They are currently reserved 100%, just like a loan for the World Bank. And then there's consideration around legal implications in the case of restructuring. I won't get into details in the interest of time, but it's all in the paper. So I will conclude it. And yeah, I invite everyone to read the paper, and really open to get feedback and spark discussions around this very interesting topic. Thank you very much.
Thank you very much, Jules. We're going to move now to the session where we're open to our very distinguished panelists. So today we have three people from different backgrounds in terms of practitioners that mentioned how multi-case stakeholder really debt for development swaps are. And we have around the room Mr. Moustapha Bamba, Assistant Director Private Debt of the Direction Générale du Financement of the Ministry of Finance of Côte d'Ivoire. So he has participated from the inside to the debt for development swap deals that Jules just mentioned. We are very looking forward to having his hands-on experience feedback. We also have David Niali from the World Bank. The World Bank has also obviously participated to the D4D in Côte d'Ivoire, but has drafted a broader approach on debt for development swap, and also created a very interesting instruments about how to compute savings even before getting into a swap. So a very policy and very practitioner tool. And Nikki Doshi, Nikki, director for the World Bank, but it's from the Nature Conservancy. Apologies for that. The Nature Conservancy has been the SDG sponsor behind, if I'm not mistaken, half of the debt for development swaps. So there's definitely a lot of experience also there. Maybe we can start with you, Mr. Bamba. It's for us very interesting to have a debt for DMO perspective. What can you tell us about your experience of the debt for development swap in Côte d'Ivoire? When did you decide it so? I mean, when and why did you decide it so? And maybe your feedback on it.
Okay. Thank you, everyone. Good morning, good afternoon. And thank you, Johan, for giving me this opportunity to present Côte d'Ivoire and also this landmark transaction. So maybe I would start by giving you a kind of context regarding this operation. As you may know, the beginning of the decade was a bit difficult for sovereign countries because of the crisis of COVID and also the Ukraine. And it was very difficult to go to the international market because the conditions were not really favorable. So Côte d'Ivoire returned to the international market only in 2024, early 2024. I think it was in February during the AFCON. And we had the issuance of the Eurobond, and in parallel, we of this operation we define a very good strategy to refinance expensive commercial loan in our books, and within this operation, we refinance a part of our portfolio. And secondly, we had some discussion with also the World Bank, more precisely the IBRD window, to set up a partial credit guarantee for around 500 million euro. So we decided to split this envelope within two parts. So the first part around 240 million euro that we use for the debt for development swap operation, and the second one we used in last September for a sustainability linked loan transaction that maybe you have seen in the market. So if I focus on the debt for development swap, it was an operation dedicated to the education sectors. So we worked with the line ministry, that was the education ministry, and also the World Bank, on the program and the use of proceeds and the saving of the loan. So on the transaction side, we will. So the discussion, we obtained the approval of the World Bank in July 2024. After that, in September, I think we started the conversation with the line ministry, and we launched the RFP with around 10 international banks the following months. And we finally selected only one bank as mandated lead arranger and lender. So if I can give you some characteristic of the transaction, so we raised 400 million euro, covered with a 60% covered BCG, first loss from IBRD, and we structure a loan for a maturity of 15 years and a 6-year grace period. So the pricing that I cannot disclose here, it was very competitive for the Republic, and the market really appreciate the structure. So maybe in terms of key lessons learned thanks to this transaction, I would say that it's really important to have a very early coordination with the different technical ministries and also the World Bank that allow us to fast track the process. So from the launch of the RFP to the execution of the transaction, I think we spent maximum 4 months. So that was very impressive. And we also anticipate a lot of time-consuming steps like ratification, RFP process, also the guarantee documentation, because it was also really important to help the bank to understand how the guarantee works. So I think it's a major point on the structure. And yes, that was the most key point I can present. And in terms of next step, I would say that for next year, we thinking about exploring those kind of blended finance transaction like debt swap, also sustainable link loan or bonds. But it will depend on the market condition, as you say, and also it will depend on our capacity to maybe identify good sectors, good project in terms of using of the savings, because it's really important to align our financing to our national development plan. And yes, we have not decided yet, but we need to have a very how can I say that, a very granular approach on our market condition, and we also need to identify the commercial loan to be refinanced, and that is the most important aspect of the debt swap. So maybe we will launch another RFP, but the decision has not been made yet at this stage.
Thank you very much, Mr. Bamba. So very impressive in terms of time to pull out such a transaction. It's kind of in a contradiction to what I was saying. It's able to be doing that in a very, very swift manner. Very impressive. But I think we'll have some more questions in the Q&A. I already have one in mind, so get ready. But now I'm going to hand it out to David, who's probably part of the reason why it took not so long to execute such a transaction. So David, the floor is yours. You have a presentation, so I'll go through it. Just let me know when to move from your slides.
Great. Thanks, everyone. David Mihai, senior economist at the Global Debt Unit, we call it, where we do a lot of the technical assistance, but also the thinking and the big picture on debt policy and debt management issues. So let me walk you through a little bit of what the World Bank's thinking on debt swaps is. I'm not going to go in, we had beautiful presentations on especially Mr. Bamba's on how the Côte d'Ivoire transaction looks like, and Jules confirmed it was a great one. So I don't think I need to dwell a lot more on it. But maybe in terms of our general approach, we can skip this slide, which gives you the big picture on the transactions and the specifics of how a buyback looks like. And let me just tell you what we saw as the problem and what we were trying to improve on. So one aspect was the efficiency of the existing transaction. So the transaction costs being a big part of it. Although it is not very transparent, if one looks at the cost of the financing that is obtained versus what is actually, so they call it the blue bond. And if you look at the actual blue loan that the government has to repay, the difference between the two gives you an impression, gives you the insight as to how much is used up by transaction costs. So that was one area where we zoomed in on, and that is linked to the SPVs, to the setup of the trust fund, the multiple arrangers, financial advisors, the guarantee fees. There's a lot of things that go in there. The second thing, and this is very much Yuan's paper and contribution there, is this emphasis on nominal savings, which distorts the picture, and instead we need to move to a present value-based approach. And I think how exactly should be calculated, I think there's an interesting discussion that Yuan presents there. There is, by design, often a focus on these long-dated bonds because you want to have a long-term saving, cash flow saving. And that might not be that, from a debt management perspective, that might not be the optimal strategy. A lot of the countries that we look at, they face liquidity pressures. So for us, the debt swaps are also an instrument to address those. And if that's the case, then you want to buy back the ones that mature in the next few years. So that was another element. That's why, for example, debt swaps appear prominently in our three-pillar approach on countries facing liquidity challenges. Fourth, and this is something maybe Jules touched on more closely, is the opportunity cost. If you, for donors like us, if we use our guarantee, that means we are not using. It's taking away from our balance sheet. It's taking away from country allocations, and so what is the alternative to using the funds for a swap is the right way to think of whether a swap was the right tool. On the transparency, I think I would highlight guarantee fees as being an area of opacity where I think from donors, especially bilateral and multilateral donors, we would expect a lot more transparency. For the bank, the guarantee fees are published on the website. They're flat. For IDA, they're a bit more complicated for IBRD, but it's all on the website. And then the intricate ramifications of what happens if a target is missed, different countries, different experiences. I think the Gabon one is one where where, for example, it was well documented that if certain KPIs are missed, then that could trigger a default and a cross defaults, and with all the financial ramifications. So, but we don't always know exactly. So I think that's another area. Third is ownership, and in some transactions, we talked with the debt management office, and they were told we're not in the driving seat at all. These transactions can often be driven by the sponsors, and so that's a major limitation. And for the bank, the use of country system for project monitoring is both linked to is very important from a country ownership, but also in more sort of long-term sustainability perspective. Again, goes back to if there are important legal clauses. I think that having the net management in the center of it is super important. Let me go to our next slide. So that's why we built together a framework in which we laid out how and when generally any stakeholders should look at debt swaps, but specifically how the World Bank itself should, when and where it should or not should not engage in debt swaps. So that's this framework document. We can go to the next slide. We've written it jointly with the fund, but there is a longer version that goes more specifics into the World Bank instrument. So there's this extended version with which is World Bank only. And in this paper, we present many things, including a decision tree. The decision tree gives you a very high level overview, and it wants to make it ramps together a lot of decisions, but I think the big ones on whether we should go ahead or not should crucially depend on whether there is imminent threat of debt restructuring, because this has been told many times. Debt swaps can help address a lot of problems, but they are no substitute for debt restructuring. So that was sort of the level one. And then there's the whole question on whether you should do bilateral or can you do commercial buybacks, and so I don't want to go through all the details here, but we can go to the next slide. The second innovation in the paper was to present the methodology for net benefit calculations. And Johan went a lot more deep in the direct benefits calculation, actually, because when you think about a debt swap, the benefits are the financial savings that the swaps itself generates, and you can measure that in multiple ways. For us, the most important is that we measure it in present value terms and not in nominal terms. And then the second element that we wanted to highlight is something Jules had beautifully illustrated with his graph on Côte d'Ivoire, is the spillover. If your swap generates $60 million in savings by swapping instrument A for instrument B, that's great. But what is can be a lot more important, and what does it do to the rest of the portfolio? Because most of the time the swap will impact 5%, 10% of the debt portfolio at best. And if that's the case, then if the rest of your debt gets more expensive, that's a big problem. And that's in Ecuador, for example, where credit rating agencies put out a warning on negative implications of the debt swap, that's a huge problem. On the other hand, if you have the kind of positive spillover story, that's amazing. In fact, I think Belize actually swapped pretty much all of its debt and got a big upgrade at the end. So that's where you see these sort of spillovers playing out well. And finally, the debt swap is only useful if the country doesn't default. If the country defaults, then all the efforts were in vain. So that's the third component you have to keep in mind. And obviously, the swap can decrease the probability of default itself. So that's for this long formula. Next slide, please. And then the final aspect I want to pick up on again is the idea of using country systems and stepping away from trust funds specifically, and having these entities in charge of executing the project rather than having the government do it. And we're not saying we should never use SPVs and trust funds to implement projects. The bank itself uses such structures in a lot of different contexts and places, but we say that where the institutional capacities are there, we should try to promote the use of these country systems and focus and move away from strictly earmarking the funding towards KPIs. And that's what we did in Côte d'Ivoire. We didn't say this is what needs to be we didn't say this entity will be in charge of spending the money. We said the government and the Minister of Education should achieve the goal of building X number of schools, and then they'll get the disbursement on this P4R instrument. So we see that as a preferable approach if and where the capacities are there, noting as well that because ultimately the questions of additionality and the questions of budget rigidities that is a very tight earmarking creates are sort of major pre-FM problems, and so that's what we're trying to address for. Okay, next slide. So this is just bringing some of these procedural aspects together, really, on how we see what we did in Côte d'Ivoire is different, and hopefully we'll see other replications of this soon in response to Johan's inquiry on the asset class. So first is to have strong prerequisites. Like, debt swaps is not for everyone. We should start from evaluating both, the debt sustainability situation, whether there's a liquidity or solvency problem ahead, and then also the capacities and transparencies in place. The second is a lot of the debt swaps we saw went after the bonds. So they bought back the Euro bonds, which are sort of readily tradable. But first of all, for an institution like the bank, that's very tricky, because if we say we're going to buy back the bonds, they might rally in price. It's very hard to keep a close lid on this kind of information. But also more practically, we see a lot of bad loans in government books. So that's another opportunity to, and some of these were taken at times of crunch, especially in the last few years when countries were blocked from the markets. So we see a lot of opportunities to save there. Competitive funding process. Mr. Bamba touched quite a bit on how the competitive process helps drive down costs, and was actually also quite speedy. We also, by using existing operations, we didn't invent the education program. It was an existing education program that we increased in ambition, that helped us go a lot faster than if we have to design from scratch. And working with the authorities, the debt office is specifically in the choice, and then the operational design is key. Next slide. So finally, two tools. So we've been working with authorities. We're doing that across our countries to see where we can help with these instruments, but we're also doing some public goods. So one of the public goods, well, the framework document is the first public good that I referenced, but the second one is this debt swap calculator, which presents a very intuitive, or hopefully intuitive, platform where you can type in what the loan is that you might want to buy back and what is the new instrument that you issue, and you can see the savings, both in nominal terms, especially the nominal savings in the first few years for addressing liquidity cases, right? That's what you care about. Are you generating some space in the first few years? And you see that visually as well in the graph below, and then also in NPV terms across the whole distribution. And then also what you're doing to the maturity of your portfolio. And then you can also discount it at 5%, which is sort of the DSA approach. And you can use the country's own yield curve to discount it. So there's some fancy tool to generate a yield curve out of 3 or 4 Euro bonds the country may have. And so you can use a very precise yield curve based estimate to discount your cash flows. So that's, and then you can export everything in Excel. And the second tool that I wanted to point to is relatively new. We launched this at the annuals in the fall. Is the global hub on debt for development swaps that we committed in Seville, and then together with the Spanish government, it's meant to be a public good repository of knowledge and information on debt swap transactions. So you'll see all the Spanish transactions there listed already. We're going to add other debt swaps by other partners. We have and hopefully a lot more resources. So this is quite new and fresh, but we thought this can be helpful in orienting people, because often information is there. It's just very hard to find across the sponsor organizations, the bilaterals that are involved. And so that's why we wanted to create this resource. With that, thanks very much. That's all I had.
Thank you very much, David. That's already a lot. So now, without any transition, I'm handing it up to Nikki. I think, Nikki, that you've been working on swaps for more than anyone else around this room. So thank you for participating, and very take care of the view of the Nature Conservancy on the state of the market, on your ongoing project, and what you can tell about this new instrument.
Thank you, Johan. I appreciate the invitation. As Johan mentioned, I'm Nikki Doshi. I'm a director with the Nature Conservancy. I'll provide a brief overview of our program and then talk about kind of the evolution of the program in the last decade since the Seychelles transaction in 2016. So the Nature Conservancy is a global conservation organization. We work in 83 countries, and our main mission is to conserve land and water on which all life depends. The Nature Bonds program was really started as a way to unlock financing for nature and conservation, especially in emerging markets where government funds always have competing priorities for other sectors such as health, food, etc. Some of the key elements of our program are co-development of conservation commitments, debt conversion, which is the financial transaction, creation and management of the Conservation Trust Fund, conservation implementation, and finally, accountability and transparency. Before I go into a bit of the evolution, maybe I should just touch upon some of the points that were discussed earlier in terms of kind of, the limitations and downsides of debt swaps. Johan, does that work? Okay, good. So it was mentioned earlier that in some of the debt swap projects, the country doesn't have ownership. That's actually quite not true, because the conservation commitments are actually co-developed with the relevant environmental or other agencies. It takes probably about 4 to 6 months, which is done in parallel with the financing transaction. The Debt Management Office is very, very closely involved with the financial teams at TNC and the lender, as well as any financial advisors that the DMO wishes to bring on board. In terms of creating a new program, I wouldn't really say we're creating a new program, given that everything we focus on is conservation. Nature is already existing. One of the key value adds we have as an organization is really to provide technical assistance to governments to enable them to implement their conservation priorities. Because when we co-develop the conservation commitments, they're always aligned with the government's national and international priorities. They have to be. Governments change. These transactions are 10 to 15 years. And so it is the responsibility of the government to implement it and follow the legal documentation. So it has to be aligned with what they would like to see in their country. There was a bit of a debate we've heard about long-dated versus short-dated bonds. It is true that if you refinance short-dated bonds, you free up liquidity. And if you refinance long-dated bonds, you have more funds unlocked for the actual program. What I will emphasize here is that, at least as a sponsor, the Nature Conservancy, we work through this with the Debt Management Office. It is up to the Debt Management Office what strategy they would like to pursue. So if there is a country that has a lot of Euro bonds, then it is easier to perhaps do a mix and match of short-dated versus long-dated. But sometimes that is not the challenge we're trying to solve for. Sometimes it's simply the country doesn't have the funds to repay, or they don't have market access, or the interest rates are too prohibitive if they go uncovered. In terms of the SPV, so I just want to clarify, the special purpose vehicle is necessary because of the political risk insurance instrument. DFC cannot provide direct coverage to sovereigns. And so it provides coverage to the SPV on behalf of the blue bond or nature bond investors. So for example, in Bahamas, there is no SPV because this was a guarantee by IDB. So the SPV is not a construct of the sponsor or the NGO. It is simply a construct of the financing instrument that is used for the transaction. I do also want to touch a little bit about the high cost of transactions. It's a little bit contradictory here because we are told, or it has been said that the transaction cost is very high, but at the same time, there is no transparency. So it's, it has to be one or the other here, right? What we can say is that in terms of transparency, like a lot of other lending agencies, IDB, for example, has its guarantee fee on its website. DFC does not disclose it, but that is not up to us. In addition, the banks, for example, do not disclose their fees. Again, that is not up to us. What I will say is that the transaction cost for debt swaps is no higher than a project finance deal. A project finance deal has fees for advisors, lawyers, a whole bunch of things, and it's not any more different. In terms of the CTF, again, this is actually done for transparency and independence, which is something that the lenders actually require. Because there have been instances in some of the countries where we've completed transactions where CTFs were expropriated. And so the value of a CTF is really just to disperse the funding in benefit of the conservation commitments that the government will implement. It is not meant to decide what conservation commitments, the government will undertake. Those are already included in the legal documentation. The other key thing about the CTF is that it is a body that's independent. The government has seats on the CTF, but they're not majority. But one of the key things of CTF is that it can also attract additional funding for donors who want to invest in the country. So for example, let me just go back to our very first deal. In Seychelles, as part of the transaction, we created a CTF called SECAT. Now, SECAT manages the funding as part of the bilateral debt swap that was negotiated and worked on by TNC as a sponsor. When the World Bank did a blue bond in 2018, I believe, in Seychelles, this blue bond is actually managed by the CTF itself. Now, one of the reasons the World Bank, I'm assuming, got comfortable with it is because it's transparent, it's independent, and had a track record of dispersing these funds for conservation projects in the country. Lastly, I'll just highlight a few things. One, when we hire banks or lawyers, this is always a competitive RFP process. It is never done one-on-one unless that is the preference of the government. And our focus, as I think we've said before, is not to unlock funds for liability management. Our focus is to unlock funds for conservation. Sometimes we can achieve both, and sometimes the numbers are simply too tight. But I just want to highlight that this is the decision of the government. If you have a small island state that is dependent on its nature for its GDP, it's tied very closely to tourism, then you will see that governments want to put all the savings into conservation itself. In other instances, you will have a certain portion going to conservation and certain going to the general budget. I'm going to move on a little bit and talk about the evolution of debt swaps in the last decade since TNC has been working on them. As Johan highlighted earlier, debt swaps has grown dramatically, and we've seen an increase not only in deal size, but also in frequency of these swaps. Just to highlight the example, the very first debt swap we did was in Seychelles, which was about $20 million. And the last transaction TNC did was $1 billion in Ecuador. In the last decade or so, we've continued to sort of innovate and adapt across our projects from Belize to Ecuador, which were the commercial debt swaps. A few things just to quickly highlight is that one, Belize was a country that was already in default. And previously there was kind of a feeling that these structures are only beneficial to countries in default. But as you see from Belize to Bahamas, Barbados, Gabon, Ecuador, none of these countries were in default. It is simply an instrument to unlock financing for conservation. So our structure is adaptable depending on what the country's needs are. Starting with Gabon, we moved from private placement to placement in the public markets. And what this has done is made the cost more efficient and transparent. We've also expanded the format that we can do in our project. So substantially, most of the other projects before Bahamas were in a bond format, but in the Bahamas transaction, we did a loan format with Standard Chartered, IDB, and 2 private sector investors. In terms of kind of market interest, we have actually seen a lot more appetite from investors. In the Ecuador, for example, was oversubscribed by 1.6 times, but also to highlight that given the number of years the program has been in place and the number of deals that have been completed, there is a lot more awareness and education about these transactions. Just to touch upon the DFIs, right? I think that increased credit enhancement from both public and private sector players has kind of increased the ecosystem of debt swaps that we can do. So for example, initially it was just DFC, and then we had IDB come in. Lately, we've also seen CAF in the Americas come into transactions, and obviously the World Bank and other players who are involved in debt for development swaps. Just one thing I'd like to highlight is the Bahamas Debt Conversion Project. It was a very innovative project because it involves a co-guarantee between IDB and Builders Asset Management, which is an impact fund, and a credit insurance from AXA XL. I think this is sort of really key, and we're hoping to do more of these structures because it's not only crowding in the private sector, but it's also a very efficient use of the capital of a DFI. Just on the Bahamas, also to highlight that when we did the Barbados project, it was meant to be an example for the market. So it was a co-guarantee between IDB and TNC. And that structure has now followed through on the Bahamas. At TNC, initially we had started with conservation for oceans. So it was called the Blue Bonds Program. But since then we have adapted and expanded to terrestrial and freshwater as well. So the Ecuador project was our first project in terrestrial biome. Lastly, I'll say is that for us, it's really important that we have a team on the ground that provides technical assistance to the government throughout the 15-year period. And so for this to take place, TNC has to have a country office and country program. Since we're not present in every single country in emerging markets, we have, in the future, we'll be partnering with other non-governmental organizations focused on conservation and sustainability so that we can partner together and kind of expand the geographic scope of our work. I think that's about it, Johan.
Thank you very much, Nikki, for this very lively discussion. It's always the case when we talk about debt swaps. And to move to the next session, which is the Q&A, we have a good 15 minutes. So just reminding everyone that you can type your question in the Q&A module. We already have a sufficient number of them. We'll try to address as much as possible. If you don't mind, I will read the questions and maybe direct it to one of our panelists, or ourselves, obviously. The first question we have is about local currency. The question is if we see any value in using debt for development swap to replace USD or euro denominated debt to local currency denominated debt. I would say before maybe handing out to David that my understanding is that debt for development swap at a very high level already have kind of a local currency debt aspect because the savings that the country will have to reimburse will come from its own budget and in principle from its own currency. So in some cases, debt for development swaps can already be a way to manage the foreign exchange risk, but it's probably not the main benefit of debt for development swaps. So I would ask maybe to David, in this formula that you have elaborated on the direct benefits and of debt swap, do you take into account the possibility to swap this debt from the hard currency to local currency, or maybe debt swap is just not the correct instrument to manage foreign exchange risk?
Thanks. Yeah, no, I think you laid it out well, Johan. So typically, the swaps we see are FX into FX, with the caveat that all the savings that's generated, it's not everything, but the savings that's generated is typically, especially in the conservation space, for example, where Nikki's work is happening, but also in many other sectors, it's typically very heavy in local currency spend. Not all of it, there might be some import content to it, but so generally, even if all the savings is earmarked towards some new spending, that is still transforming some FX obligation towards mostly local currency spend obligations. So that's already in how so that's we see demand for buying back domestic debt more than what is described here is raising domestic debt to buy back FX. What we see is more countries interested in raising credit enhanced FX debt to buy back domestic debt. And we're a little bit skeptical of replacing that, because we see that even if the maths work out in terms of the saving, if you take into account that the interest rate differentials, and that gets a lot more complicated into the maths on how you would evaluate the equivalency. It gets a lot more complicated, but also the risks that you're generating by replacing domestic debt with not only FX debt, but actually, and I know FDL has another paper on this issue about preferred creditor debt, which the World Bank is, which already countries also have a lot of. That creates new set of complexities. I would also maybe highlight that when you borrow from the World Bank, depending on whether it's IDA or IBRD, you have some choice in currency. So in IDA, you can choose euros, yens, not just like SDRs or USDs. And in IBRD, you even have a lot more local currency options and hedges and other things you can do. So if countries want to convert their liabilities that they have with the World Bank from one currency to the other, there's plenty of opportunity to do that. It doesn't need to be done through the swap, so that we can work with authorities that want to reduce their exchange rate exposures through a separate instrument, or we could even layer it if needed. I'll stop here. I think I got into a lot of details.
Thank you very much. As expected, we have a few questions on Côte d'Ivoire, so we'll look at you, Mr. Bamba. There's one very specific question about whether the school program, so it was 30 additional school, whether that was additional to what was initially planned in the existing program, or non-additional, just a way to finance the existing Côte d'Ivoire program. So whether the debt for development swap brings some additionality to the discussion. And the question I had actually, and I think it's related to other questions around that we have received, is why did you go for education? Was it because discussing with because the program was there, you mentioned, because discussing with the education ministry was easier than with any other ministry? So how did the decision to go for schools made sense in this debt swap, and when this decision was made? Was it early on and then you moved to the financial part, or way down the road after the financial was set up? Was it additional, and why education and not conservation, let's say? You're on mute, Mr. Bamba.
Sorry. So thank you for these two interesting questions. Maybe I will try to answer both at the same time. So yes, the program was actually existing, because it's as I said before, our strategy is to finance the national development plan. So we identify some program within our plan, and we decided to work with the World Bank and the line ministry. The second question was about when we start the conversation with the line ministry and why we decide education. Is that correct?
Yes.
Yes. Okay. So the education, because it's a key point of our need, our challenge, not only in Côte d'Ivoire, I think in Africa, it's really important. And if you see the annual budget, you will see that the education ministry is one of the biggest, allocation consuming. So I would say, yes, I think it was a natural decision. Maybe we could have health or nature like environment, but we also develop another transaction linked to environment and power. So education is one of our key, ministry benefiting from the support of the state. So that was the point. And the second point, I think the discussion has been done in parallel, with the line ministry and also the financial part.
Thank you very much. We also have questions about the credit enhancements, and I will be looking at you, Nikki. There's one specific question that I see about the Bahamas deal. It's true that in the Bahamas, something interesting happened, is that the guarantee making able to lower the cost of the new borrowing was not just provided by development partners, but also by private insurers, and in particular AXA. Can you go down? Can you explain a bit more about the role of AXA and the benefit of having a private insurer in this overall transaction structure? That's one. There's also a question more specific about DFC, about whether, the question is that DFC is suggesting that DFC is completely out of the market, which apparently, given that we've heard some news about a potential new deal of DFC in East Africa, it's probably not a definite answer there. But should we expect more credit enhancements if DFC is not in anymore? What is your view about the credit enhancement market in a way?
Thanks, Johan. So on Bahamas, like I mentioned, one of the key things we have been trying to do since the Barbados transaction is to really include more private sector investors in these transactions. And the role of AXA XL was simply one to play of a co-insurer, in addition to the role of the impact fund investor and IDB. As I mentioned earlier, for IDB, this is a great way to utilize their capital, is very efficient use of their balance sheet, and also aligns with their mandate of crowding in private sector investors. You mentioned here that DFC has been a supporter of our transactions for a very long time, and they are the ones that provided the most amount of funding, which we are very grateful to them for. Having said that, there are other credit enhancers in the space. So like I just said about IDB, right? Now, if IDB was able to use less of their own funding because it crowded in private sector, that means they have freed up some capital to do funding elsewhere in the Americas. We're also seeing other credit enhancers come into the space, including CAF and the Caribbean Development Bank. I think they released a facility on climate resilience with CAF and IDB, as well as we are speaking to some European DFIs who are working on a few ongoing projects. We've also heard of ADB's interest to work on projects in Asia. So while DFC has been a great supporter, has provided a lot of the funding for the projects, I do see that there is an opportunity for other players to step up, and we're having active discussions with them all. Just to flag, even the World Bank has stepped into this game, so they are another potential credit enhancer for their own program. It doesn't have to be for conservation or TNC.
Thank you very much, Nikki. And I think that leads to the final part of our discussion, which is concluding remarks. Martin, are you still able to connect? If not, I will just thank everyone for the very, very interesting discussion. Last year, as I said, it was a very busy time for debt swaps. Let's see what the next couple of weeks will offer us. But in any case, we're all looking at 2026. FDL is providing part of the bricks in this discussion, but around the table, we have the people that have made 2024 extremely interesting. And thanks for adding your feedback. We will be sharing the recording of this webinar, but just stay tuned to our websites for more studies on debt swaps, on development finance overall. And thank you all for connecting and looking forward to keep this discussion going. Thank you all.
Thanks, everyone.
Thank you.
Thank you, everyone. Good day.
Thank you.
Bye.